So I posted a review of Rich Uncles a little while ago, and I quickly got about 1,500 hits. And today I got an email from Rich Uncles, and they're still pushing this REIT. I still hear these commercials. If it's such a great investment, then why not just sell it to the institutional investors and be done with it? Seems to me that'd be a whole lot easier. But anyway, so the headline of this email was, "Stock market volatility making you nervous?" First of all, again, you don't put 100% of your investment money in stocks. And if you can't handle stock market volatility, you diversify into slow, boring bonds because stocks and bonds balance each other out. And of course, what happened over the last 5 days as stocks have been crashing? Lo and behold, bonds were up 0.5%. Just as we would expect, when stocks fall, money runs to the safety of bonds and vice versa. And if you're sitting on the sidelines with money in the bank earning 0 point whatever percent, stock market volatility shouldn't be making you nervous. It should be making you excited because stocks just went on sale at about a 12% discount. And if you want to follow the advice of someone like Rick Edelman, who usually recommends about putting 4% of your savings in real estate, even the real estate ETF VNQ went on sale for about a 10% discount. And if you're already invested in some stocks and you've seen the stock portion of your portfolio decline, then you're still in the same boat. You should be looking at this decline as a great opportunity to rebalance your portfolio of bond and stock index funds by moving a little bit out of your bond fund or funds and into your stock index fund to take advantage of the sale. Rebalancing adds up to 0.35% per year in increased returns, according to Vanguard. But the problem is investors are famous for doing the complete opposite. They buy high and they sell low. And when stocks tank, they panic and sell. So if you're panicking now after stocks have already crashed 12%, you have already missed the train. You don't sell low. Investors are famous, for example, selling all their stocks in 2009 after the markets had already crashed. Then they got into these dreaded annuities that I have a zillion videos on, other alternative investments like limited partnerships, non-traded REITs, life settlement investments, whole life insurance, universal life, promissory notes, and other stuff when they should have been doing the complete opposite. They should have been gradually moving more and more money into stocks as stocks went more and more on sale. So back to real estate. Real estate tends to go through cycles of ups and downs, and real estate doesn't always move lock, stock, and barrel with stocks. And lately, real estate has been enjoying a bit of a boom. I mean, you can just look on Zillow at how residential housing has been going up in value. So if you're hell-bent on investing in real estate, you have to ask yourself the question, am I getting in low or am I getting in high? According to Placer Summit Financial Group, the ideal time to be acquiring property is after a market decline in real estate prices, when prices are lower and cap rates are high, making it more realistic for a REIT to pay out its higher yield and return your principal. So it's really important to ask yourself, where in the real estate cycle are we? Now, the promoters of Rich Uncles love to talk about how non-traded REITs are not listed on the stock market and how publicly traded REITs are more volatile than non-traded REITs. Well, according to one of the biggest REIT investors in the world, this is a misdirection with regard to non-traded REITs in general. He says you can't measure the volatility of these investments just because they don't trade. He says that while they are not exposed to the day-to-day volatility of the public markets, REIT net asset values are exposed to economic volatility. Real estate is not immune to economic changes, and prices of REITs are actually set at the discretion of REIT managers. And the criticism of non-traded REITs in general is that these prices can be highly misleading, as they can be unrelated to the value of the REIT or its holdings. So if you have a piece of paper that says that your shares are worth $10 a share, but the value of real estate has gone up or gone down, you're kidding yourself. Eventually, the true true value of your shares is going to be reflected at the liquidation phase of the life cycle of the REIT. And as they say, it isn't until the tide goes out that you find out who, if anybody, has been swimming naked. Also, here's a quote from the Securities Litigation Consulting Group. You can pause the video and read it if you like. Another point, if you invest in a REIT, you're in it for what, 7 years, 10 years? So today, this week, stocks are down, but, and maybe they're down next week, maybe a month from now, maybe 6 months from now. But you're a long-term investor, so what matters is the end value of your investment in 7 years or 10 years or whatever the case may be. Now, another thing that the promoters of rich uncles keep talking about is the fact that there are no external fees. 8% broker commission, or with longer duration REITs, it might be 10%. But again, broker commissions is just one part of the fee puzzle that you have to evaluate on your own. You have to evaluate all of the internal fees. Now, typically with non-traded REITs, you'll see that there's an advisor that's earning between 1% and 2%. There's typically organizational and offering expenses, asset management fees of 1% to 2% of gross real estate assets, acquisition and disposition fees of 1% to 3% of acquisition or sale price, and finally, debt financing fees of approximately 1%. All this stuff adds up. Also, the criticism about non-traded REITs doesn't start and end with just fees and lack of liquidity or potential for lack of liquidity. Now, I'm not going to go into great detail, but one is funds from operation to dividend payout ratio. Publicly traded REITs typically have a ratio of about 70%, and lower is better. Lower means greater likelihood that the REIT will meet its obligations to continue to pay dividends, etc. Now, non-traded REITs typically have a ratio of about 110 to 140%. Now, I don't know what Rich Uncle's ratio is, and oddly enough, so far as I can tell, maybe I didn't look hard enough, but from what I can tell, I don't see any mention of this ratio on their website. And this is important because when you're paying out 7% dividends or whatever, this can put some stress on a REIT. But to the unsophisticated investor, 7% might sound great, but wait a minute. REITs start paying these high dividends before the entity has even gotten out of the gates as far as spending your money. Managers have to raise money and acquire property and tenants before they can generate revenue. Yet they're paying these high dividends before they've put your money to work. That's not a perfectly efficient investment. Another downside with non-traded REITs, all non-traded REITs have 3 stages to their life cycle: raise capital and acquire property, management, and disposition, winding the whole operation down. But just think about that. Disposition. What happens when you sell property? It's costly. You pay broker commissions. The advisor and people running the REIT get paid again for their services. And this comes out of your investment. But so you compare that with, for example, a publicly traded company that's an ongoing operation that never stops. There might be a little bit of acquisition of new property. Maybe they dump some unprofitable property. But for the most part, there's no expensive 3-stage life cycle. It's one ongoing stage: management. And if they need money, they don't have to pay a promoter who in turn has to pay for advertising on the radio. They're already traded on the New York Stock Exchange. Another downside with non-traded REITs is what's called the blind pool structure. Non-traded REITs raise money before buying and or identifying investments, and the process can take several years. And so investors may find it difficult to evaluate the merits of the investment, or at least all of the investment. Anyway, that's it for now. If you didn't see my review of Rich Uncles, you can click the link you see on your screen.